This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome Mark Flickinger, General Partner and COO of VIP Capital. And, we discuss a lot of different avenues of alternative investing and the different types of assets that make up that class. But more often than not, people kind of think of alternative assets as private equity, right? People investing in private stocks, bonds, all those kind of fun things that, kind of have a real attractive, buzz about them. But people don't often understand that in the world of private equities, there's a lot more than just equity plays that are to be had. There are a multitude of different offerings, whether that is in the private equity space of actually owning equitable interests in different projects or companies, but there's also the private credit space and the private debt space, which I feel is really kind of an served from a content perspective avenue that people should really be looking at with a much more analytical lens, because there's a lot of different ways to kind of crack open the egg of private equities and private investments, and to not kind of look at a whole market segment really is doing yourself a disservice. So Mark, thank you very much for being on with us today. If you wouldn't mind, give us a little bit of background about yourself and how you kind of came to be in your current position with VIP Capital.
Thanks, Alex. It's excited to be here. I appreciate the opportunity to chat with you. As Alex mentioned, I'm general partner and COO here at VIP Capital. I've been here for about a decade, so lots happened in that decade, which is pretty exciting. It's hard to believe that it's a decade. I didn't have as much gray hair when I started back then. A lot has evolved. I think particularly people's ability to access and use private equity, just private investing in general. And as you said, there's a bunch of different types of private investing. When I started VIP Capital, we did predominantly private equity. We're venture capital, kind of first institutional capital. From an equity perspective, we're investing in exchange for ownership of businesses, and then we help those businesses grow and scale. But to your point, really over the past, call it 6+ years, private credit has become more and more a great opportunity and an investment avenue for high net worth investors and for people to use, whether they're doing taxable or tax advantage accounts. Some of that is the structural aspects of what's happened. For those that were paying attention a couple of years ago, there were a lot of banks that lent into the private space. A couple of those banks got over leveraged and ended up closing. The restrictions on banks to being the ones that were loaning capital to these kind of privately held promising companies have become more restrictive, and therefore their willingness to go do that type of lending has pretty much dried up. That's been sort of a real boom for private credit. Hard money lenders, people who are raising capital in a fund, they're deploying capital into promising companies and promising assets, but they're deploying it as a loan, right? We're not doing it in exchange for ownership of the company. We're basically saying, you have a good business that needs fuel to grow, and there's a bunch of reasons why, but the best way for you to put capital on your balance sheet to continue to grow is a loan, similar to borrowing money to buy a house, a mortgage or something like that. That loan is typically 3 to 5 years, and people come back. So from our perspective, we have a couple of talented managers that's under a brand name Lago that have been doing it for decades. And, we're fortunate enough to partner with them and some of the success they've had in what I would call sort of a niche market, an underserved market in that private credit space, given that it's growing so quickly through time.
Yeah, absolutely. And that's a really good point to bring up, is that, as investors, we always are trying to find that competitive edge in value, right? What that is looks, completely different depending on what market you're looking at. But when you look at kind of those market drivers and those needs, right, you have the velocity of capital in the private space. Again, you can't always necessarily go to your bank and get business loans, right? And especially for companies that are in growth stages that maybe don't have the revenue or profitability to go to just walk into JP Morgan and grab the financing that they're looking for. Where do you find that? And especially to your point of, the over leverage of some banks that have pulled back, or in some cases gone away completely, with the example that we look at with people like Silicon Valley Bank, which again is not, the greatest example, because there were other, external factors that kind of played into that. But you have people in the space kind of pulling out, which creates that vacuum and opportunity for investors to come in. So from that perspective of looking at, kind of the market opportunities that present themselves in the private credit space, what are some of the kind of key factors that make, I guess here's the question, is the availability of people offering an equitable interest diminishing while their need for capital is either raising or growing, or is the attractiveness of just going and saying, hey, instead of taking equity, we will provide debt, a more attractive option just on face value? Maybe kind of speak to that kind of differentiating factor a little bit.
Yeah, it's great. You highlighted one of the key points, and I think you have to start with the company that needs the money or wants the money. Needs
Right,
probably the right word, but they need the money to keep the business going. And I think from an entrepreneur's perspective, typical path is I have a great idea. I'm going to go build a solution to a problem in a market, and then I need someone else to believe in that idea as well. So I have the capital to fuel it. Early on, it's an equity play, but at some point in the maturation of that business, taking on more equity at, particularly now, which are relatively repressed valuations relative to what they were 2 to 3 years ago, maybe not historically, they don't want to give away more of their business by taking more capital on the balance sheet. And so what you see is these businesses that start to scale. They have $60 to $70 million of annual recurring revenue on average across a portfolio. They're probably cash flow positive. Not every business, but they're probably cash flow positive. And they're approaching, call it $200 million of value, meaning each company is valued at $200 million. Well, their options become somewhat limited. As you said, they're not big enough yet to be able to just walk into the bank and say, hey, we need a small business loan of $20 million to keep my business going, because they're not quite that big. And a lot of the private credit funds are multi-billion-dollar funds that are trying to deploy 20 million at a time. So you end up with this little bit of a gap from an entrepreneur's perspective where they say, hey, I'm growing at 60, 70% year over year. My business is growing. I don't want to take more equity because I further dilute my ownership percentage down. I need someone that's willing to loan me capital. And so there's this sort of gap in the market where you become the preferred option for the entrepreneur because they don't want to dilute themselves down from an ownership perspective, but they have a business that's getting there, but it's not quite the multi-$100 million revenue business that's happening. And so finding people that are thoughtful about that know that space, can underwrite to that space, can really look at the metrics of the business and say, this is a good loan, right? This is a good loan for me to put on. It's secured. It's top of the stack. There's a bunch of different features around that we happily can go into. But from the entrepreneur's perspective, I think that's where it starts, which is if my alternatives are, if I want to continue to grow my business, which they do, my alternatives are further dilute my ownership percentage through equity versus I'll take a loan that allows me to fuel to what ultimately would be a greater valuation. So when they take equity, it's less dilution. So I think it starts with the entrepreneur is sort of why would I take one versus the other? And then if you can understand what the entrepreneur's needs are, then you can make sure the product that you're providing or the product or the solution you're providing really fits those needs in a way that everybody wins, right? The entrepreneur wins, the investors and the general partner win, and then the general partner who's doing the work ultimately win. But that's where we're seeing the market open up is that there is less going on in the equity side. There's still people available deploying capital, but there's less. And the terms, because of that, because it's less competitive, the terms are a little bit repressed. And so the entrepreneur seat is, I want to keep going with my business. If I do have an alternative to taking more equity onto the balance sheet, let me explore that and see if it's the right move for me.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.